Okay, hi everyone. This is going to be the lecture for the PowerPoint for Chapter 1. This chapter, we're really doing a high-level overview of managerial accounting, and we're really going to look at a variety of different ways that you can classify costs. So, with that being said, right, many of you who are in this class have already taken an accounting course. In other words, you have probably taken financial accounting. If you recall things like debits, credits, the balance sheet, the income statement, right? Now, the purpose of that class was really talking about external users of the business, things like investors, lenders, creditors, right? They're trying to evaluate the health of the company to determine if they want to invest or lend money. Managerial accounting, in distinction, we're more concerned here with internal users of the business. So, like managers inside of the business. How can we use financial information to help us make decisions, right? Now, one thing with managerial accounting, if you really liked financial accounting, you may not like managerial accounting. If you didn't like financial accounting, you may like managerial accounting. And if you like financial accounting, you could like managerial accounting. Where I'm going with this is managerial accounting is a very different type of course. It is in the framework of accounting, but it's not similar to financial accounting in the sense that it's a very different course. It would be like if you took Spanish and then you took Mandarin or something, right? They're both a foreign language, but they're very different from each other. In any event, right? When we're talking about managerial accounting, we're talking about internal users, those like managers inside the business. And we're really looking at how we can use financial information to help those managers with things like planning, controlling, and decision making. So planning being things like establishing and developing a course of action to achieve goals. Controlling, making sure, right, we're on the right path to achieve those goals. And then decision making, selecting a course of action from different alternatives. So, if we have ABC that we can choose from, which one should we pick? Now, the one thing I want to, again, preface, because this is the Chapter 1 lecture here, is accounting is not learned through, like, reading. In other words, I always say accounting is learned through doing. So with that being the case, right, when we go through these PowerPoints, this is really going to be like an orientation. It's going to be more like high level. And then when we get into the problems, the second video, that's where we're going to be doing more of the doing. So if you're watching the PowerPoint videos and you're like, what does that mean? Or I don't really understand that. That's a very like natural or normal experience to have happen. Accounting doesn't click. It doesn't all come together until you kind of look at the beginning things like tee it up, do problems, then look at things outside of class like the optional problems, do the homework. Then it kind of all magically comes together there at the end. So I just say that as kind of a prefatory remark. Now, when we're dealing with internal users of a business, managers, one of the big things we're really going to be looking at are costs, right? How do we manage our costs? How do we plan for our costs? How do we aid in decision making with costs? So when we're talking about costs, right, inside a business, what are our costs of running this business? There are a variety of different cost classifications, ways that we can describe costs or classify them. So the 5 different cost classification purposes, like how we can describe costs or areas in which we describe costs differently, are assigning costs to cost objects, costs of manufacturing, preparing financial statements, predicting cost behavior, in decision making. So like 1, 2, 3, 4, 5. Now, each of them we're going to look at individually, but essentially what we're doing here is we're going to use the word cost like 15 different times with like 15 different definitions to it. So I'm just making you aware of this moving forward. So the first primary purpose of cost classification, or where we would use it, is to assign costs to cost objects. So for things like pricing, or if we're preparing a profitability study, or we're looking to control our spending. What is a cost object? This is really anything for which a cost data is desired. So, hey, what is the cost of our product, a customer, the plant, our office location, a particular department within the business? What does this cost us, right? What we're looking at there is the cost object. And what we do is once we identify that cost object, we assign costs accordingly. So in that framework, costs can be direct costs or they can be indirect costs. A direct cost is basically a directly traceable cost. It directly relates to and is traceable to the cost object in question. So if you were looking at a cost object of a department, right? So we're a manufacturing firm. We have several different departments that help us in this process. Maybe we have a manufacturing department or something. We want to know, what does that specific department cost our business? Well, in that case, a direct cost, one that's directly traceable to the cost object, namely the department, would be the salary of an employee. In distinction, we have these things called indirect costs. So these are basically costs that are not directly traceable to a specified cost object. So for example, if we have a manufacturer manager salary where there would be multiple products in play, if we were looking at one of the products, right, that manufacturer's salary, that would be an indirect cost. In other words, yeah, it is related to it, but it's not directly related to it. That manager oversees various different products there, versus the employee in the department in the direct cost example, it's like directly traceable, right? It's like you can say 100%, it traces right there, it makes sense. Now, a given cost is not always direct or always indirect. In other words, a employee's salary in the first example is a direct cost, right? But that doesn't mean every single time you see a salary that it's a direct cost. In other words, whether a cost is direct or indirect depends on the cost object in question. So if the cost object is the manufacturing department, right, we're looking at the department as a whole, then the manager's salary is a direct cost. If, however, the cost object is a particular product, then the manager's salary is going to be an indirect cost. So same kind of, cost here, a manager's salary, but in one case it's direct, in another, it's indirect. It really depends on what the cost object is. So always focus in on the cost object first, then look at the cost to determine whether it's direct or indirect. Second purpose here of cost classification, right? Another way we can describe costs. They can be manufacturing costs or they can be non-manufacturing costs. So manufacturing costs are basically those costs directly related to manufacturing. And it can be our direct materials, our direct labor, then it can be other indirect costs. So our manufacturing overhead, right? So indirect materials, indirect labor, and other indirect, as I have here, in the plant, so like in the manufacturing plant, costs. So we'll look at this, we'll go through some examples, but again, manufacturing cost is broken into two things, a direct component and indirect. And with that, there's three kind of overall components to it: direct materials, direct labor, and manufacturing overhead. In distinction, right, we have non-manufacturing costs. So these are like selling costs and administrative costs. We'll look at these, we'll define them in a later slide here. So again, costs of manufacturing, you have your direct materials, you have your direct labor, you have your manufacturing overhead. Some of them are direct, some of them are indirect. Oftentimes they'll call these two conversion costs, and then oftentimes they'll call these two prime costs. So in manufacturing costs, right, we said there's kind of three components to it. There's direct materials, there's direct labor, and then there's manufacturing overhead. Direct materials are basically directly traceable raw materials that are integral to the finished product. So let's imagine, right, that we had a pizza shop. We'll kind of keep it simple here, right? We make pizzas. That's what we're manufacturing. In that case, our direct materials might be like our cheese, our flour, right? Our water that we use to make the dough. Those are our direct materials. Now, the second component is called direct labor. These are essentially the labor costs that are directly traceable to the product we're making. So, for example, if we have an employee at the pizza shop and they're the ones who are kind of mixing the flour with the water, then they're putting the pizza on their hand and throwing it up and spinning it. They put the cheese on. They're directly working with the product. That would be a direct labor cost. And then the third component we have is manufacturing overhead. And this includes like indirect materials. So these are raw materials not directly traceable to the finished product. So maybe if you were like putting together a product and there was like a little bit of like screws or glue that you would use, that would be an indirect material. Then you would have indirect labor. So this would be employees that basically play an essential role in managing the facility, but it's not directly traceable to a specified product. So maybe that's like the manager of the pizza place, right? And then as I have here, we also have other indirect associated costs that occur within the factory, or within the place that we're really making our product. So things like depreciation, utility costs, property taxes, insurance premiums. All of these are basically associated with running the manufacturing operations. And the idea with our manufacturing overhead, it's one of those things, like if you've ever said, or you walked into a place and you're like, wow, I can't believe they charge so much for, I don't know, a pizza or something, right? Like, why is a pizza $15 or $20 when it's only like $2 worth of materials? Flour's cheap, cheese is relatively cheap. And really what the manager of the pizza place would say, well, hey, that you're just looking at the direct materials there. We also have other manufacturing costs. We have our direct labor, like I got to pay my employees. And then I have overhead, right? I have like the utilities to run the place. I have property taxes, so on and so forth. So these three items are manufacturing costs. In distinction, right, we have non-manufacturing costs, and this is broken out between selling costs and administrative costs. Selling costs are those costs associated with obtaining and servicing customers. So, hey, how would you obtain customers or service a customer? That would be things like advertising, shipping, sales commissions, right, sales salaries, things in the finished good warehouse, basically things that happen outside of and after the product is made, right? So, hey, we have our product, we need to advertise for it, or we need to ship it, right? Those would be selling costs. And another thing, for example, if you've ever sold on eBay, right? Maybe you sell something for $100 on there, but then you got to pay shipping, you got to pay, a selling cost to eBay. So that's the idea with selling costs. Administrative costs, when you're looking like at the cost of manufacturing, it's a non-manufacturing cost, and it really relates to general management of the organization. So in this case, it would be like the high-level executives, right? accounting, legal, our secretaries, other kind of general costs to run the business that aren't really directly involved or associated with that manufacturing process. So if we were looking at an iPhone, right? There's always the new iPhone. It's probably iPhone 25 at this point or something. Who knows how they categorize them? There's probably like 8 different cameras on the one side and so on and so forth. We could tell this is a more modern iPhone because it doesn't have the touch button down there. In any event, right? If we were looking at an iPhone and we were saying, hey, could you please tell me the manufacturing costs? In other words, what might be things like the direct materials, the direct labor, the manufacturing overhead? So the direct materials would be those things that go into it, maybe like the computer chips or the shell case, Our direct labor, that would be like people who are working on the assembly line, putting the iPhones together. And then our manufacturing overhead, this would be things like our utilities, right? Other kind of indirect costs in the plant that happen. And then for our non-manufacturing costs, things that would be our selling costs, that might be like advertising, right? Maybe we play the fancy iPhone commercial on TV. We have to pay for that. That's an expense. And then for administrative costs, hey, we have a big fancy CEO here. We have a legal team. We have an accounting team. Right? So basically the idea is here is managers, when we're looking at costs from one point of view, one way we can describe them as a manufacturing or a non-manufacturing cost. It's just like one vantage point, one angle, among various other ways we can classify costs. So a third way we can classify costs or purpose of cost classification would be preparing financial statements, right? So if you remember in financial accounting, right, one of the things, and I know maybe some of you took it a semester ago, maybe some of you took it 5 years ago. So I try to teach this in a way where it's understandable to everyone. But if you remember, with regard to inventory, if you're using GAAP, right, those generally accepted accounting principles, the rules of financial accounting, they tell you that when you buy inventory, generally you're not going to immediately expense it, right? Instead, what you do if you buy inventory for financial accounting purposes is you're going to capitalize it. In other words, put it on the balance sheet as an asset, as inventory. Thereafter, and then, and only then, once you sell it, then you take the expense as costs of goods sold. So if you buy inventory or if you make inventory, right, that goes on the balance sheet first. And then when you sell it, it goes on the income statement. And when you're talking about a manufacturer, right, in that regard, we need to distinguish when we're preparing financial statements the difference between our product costs and our period costs. And the idea here is product costs are basically all those costs that go into making a product. They happen inside the plant, like the manufacturing plant. Basically what we do is things like our direct materials, our direct labor, our manufacturing overhead, all of these become part of inventory. Right, we have that inventory account on the balance sheet. But then we would subdivide inventory into kind of our raw materials, our WIP, right, our work in process, and then our finished goods inventory. In distinction, right, we also have, when we're preparing financial statements, we have to be aware of period costs. So these are basically costs that aren't product costs, and they happen traditionally in the office or not in the manufacturing plant. So these are expensed on the income statement in the period incurred. So basically, as they happen, you expense them. So like SG&A, sales, office rent, our worker salaries, depreciation, right? Basically, on item, in that case, depreciation on items not in the manufacturing plant. But these are things you expense as you incur. Okay, so we're preparing financial statements here. We said we have product costs versus period costs. Period costs are simpler, right? Selling and administrative. You're going to expense those as they incur. Our product costs are going to be put on the balance sheet first, and then once we sell the goods, we take the expense as cost of goods sold. Now, when we put them on the balance sheet, right, we're going to break it out, our inventory between raw materials, WIP, right, our work in process inventory, and then our finished goods, right, and then you sell it, take the expense. Next, right, another area we can use cost classification, why it's important. We can use cost classification when we're analyzing cost behavior. Now, cost behavior, this refers to how a cost reacts to a change in a level of activity. So in other words, as an activity level changes, how does the cost change? And in this framework, right, we can break out our cost categorizations into three types. We have variable costs, we have fixed cost, and we have mixed costs. So let's look at each of those in light of predicting cost behavior. So a variable cost, this is one that varies in total, and it depends on the level of activity. However, the per unit cost remains the same. So as I have here, for example, the more direct materials you buy, the activity base, the greater overall cost for direct materials. It's kind of like if I went in and I said, hey, go into the mall and buy some t-shirts, right? And let's just assume every t-shirt costs $20. So your total cost in that case is going to be a function of how many t-shirts you buy, the activity base. So if you buy 5 t-shirts, it's $100. If you buy 10, it's $200, right? It's just like shopping. The more you buy, the greater the activity base, the greater the overall cost. But what doesn't change, and for purposes of our example, is that flat amount per unit, the $20 per t-shirt. Now, for a cost to be variable, it has to be variable with respect to something. In other words, there has to be an activity base or a cost driver. So in manufacturing or in managerial accounting, common activity bases would include things like our direct labor hours, our machine hours, our units produced, or our units sold. And as I have here, right, variable cost can be expressed on a per unit basis. Per unit cost remains the same, but because it's a variable cost, the total cost is going to change. So in other words, right, if we were having $30 per meal per customer, if that's what it cost us, if there were 10 customers, we'd have $300 total, $30 per unit. If we have 20 customers, right, it goes up, it's going to be $600 total cost, still $30 per unit. If we have 5 customers, right, it went down, we're going to have $150 of total costs. However, still $30 per unit. So the idea with a variable cost, again, is the per unit cost remains the same, 30, 30, 30, but the total cost is what changes, 300, 600, 150. That's a function of or depends upon the activity base. So in the activity base here would be the number of customers. Now, in distinction, right, we also have fixed costs when we're predicting cost behavior. And basically, these are costs that remain constant in total. However, the per unit cost is going to be what changes. And when you're looking at fixed costs, you can kind of subdivide them into, is this a committed fixed cost? Something that's kind of routine that would happen over a multi-year period, so like taxes, right? You don't really have much of a choice there. Versus, is this a discretionary fixed cost? It's comes from our decisions, right? So advertising, maybe we pay a flat $500 for advertising. That was a choice we made. It was discretionary. Now, with fixed costs, the total cost is going to remain the same, right? Regardless of activity level. So in this framework, what happens is the average fixed cost per unit, this is going to become smaller as the activity level becomes bigger. In other words, what happens here is with fixed costs, our total cost remains the same, but our per unit cost changes. So if we look at this, right, if we have a $500 fixed rent expense, it's always going to be $500, right? It's a fixed amount. If we have one tenant, then the per unit cost is going to be $500 per tenant, right? If two tenants live in that apartment, that's the $500, right? Then it's going to be $250 per tenant. If 5 live in there, right? We cram 5 in, and it's going to be $100 per tenant. So we can see here, right? The 500 fixed expense, the total cost is always the same. But as the activity base increases, 1, 2, 5, the per unit cost decreases. 500, 250, 100. Right? It's kind of like, I know at one point Panera Bread was doing something where it was like $15 a month for unlimited coffee, right? So it's a flat $15 you pay. Now, if you only drink 1 cup of coffee that month, you just paid $15 per cup of coffee, right? It's like not a good deal. However, if you go there every day, right, more usage, increase in activity base, right? 1, 2, 5, you go to the coffee shop 2 times, 4 times, 8 times. Every time you go and get a coffee, the per unit cup goes down, the cost of it. And ultimately what you're trying to do here, right, is get that per unit cost below what it would be if you just walked in and bought a cup of coffee. So in other words, if you go in Panera and it's like $3 for a cup of coffee, you would hope to get the unlimited coffee for $15 a month, and maybe it would cost you $1 a cup or something, right? Now with those, right, they of course want you to buy other things when you come in. That's how they like really make the money on those. But that's just an example to kind of show you that. Now, this is a graphical representation of variable costs versus fixed costs, right? So we have our activity level over here, and you can see, right? And we have our total costs over here, right? So in this case, for a variable cost, as our activity base increases, the more t-shirts we buy, right? Our total cost also increases. It's going to rise up. With a fixed cost, in distinction, it's always fixed. It's flat. In other words, it doesn't matter how our activity level changes, how many cups at Panera you have, it's still going to be $15 a month, right? It's still a flat amount. Now, when we're talking about cost behavior in these like variable and fixed cost, one thing that we have to be aware of here when we're graphing it, we're making assumptions, is this thing called the relevant range. And it's basically the threshold within which our assertions hold true. In other words, what happens here is the relevant range is going to set a minimum and maximum within which our cost predictions are true. So for example, if we have a relevant range that says, hey, the cost of an item is $5 per unit if we buy at least 1,000, but not more than 2,000. So in other words, if we're within that range, if the statement is true, in other words, we buy somewhere between 1,000, but not more than 2,000, it should cost $5. So right here, we're right in the middle, we're within the relevant range, it's $5. Our statement, it will cost $5, holds true. If, however, we depart from that relevant range, maybe we buy 990 or 2001, right? We're getting outside of the range, our assertion here, $5 per unit, may not necessarily hold true. So maybe it would become more than $5 per unit or less than $5 per unit. Now, the third item here is a mixed cost. So this has a fixed component to it and a variable component. So maybe an easy way to discuss this would just say, hey, imagine you have a base cable bill of $100 per month, right? A flat $100. And then every time you rent a movie, right, on cable, you get on demand and all that. Let's just say it's $15 to rent a movie. And let's say you're a big Marvel fan, you really like the Avengers. So we know there's 4 Avengers movies. They probably could have made them into 3, but they had to get that money grab to get the 4th one. It's kind of like Harry Potter, how they had to make the 4th one, or the 8th one, or 9th one, whatever it was, 7.5, then 8. The extra marginal income. But yeah, I think that 4th Marvel Avengers movie was actually probably worth it. That was a pretty good movie. In any event, right, when we're talking about this, we're saying, hey, we got $100 per month flat cable bill, and then we want to watch 4 Avengers movies, right? So there's a fixed component to this, the $100, and then a variable component. It's going to be the number of movies we rent. And what we do here to figure out our total costs, or our total mixed costs, would be use this equation, y equals a plus b times x. And each of those variables have their own definition, right? What they mean, you can look at them, but sometimes it's easier to just kind of plug and chug here. In other words, we have our flat $100 we pay for our bill each month. Then we add that to $15 a movie times 4 movies we're watching, right? So our total mixed cost here is going to be $160. So there's like a fixed component and then a variable component. Just add them together. And again, we can, graphically express this, right, where we have kind of our fixed component, the $100, and then our total cost is going to be a function of, right, it's going to go up how many movies we rent. So if we rent 1, it might be here. If we rent 2, it might be there, so on and so forth. Now, the last area where we are going to use cost classifications where they're important is in decision making. So one of the rules we're going to talk about in managerial accounting is that when you make decisions as an internal user, a manager, you should really only consider relevant costs and relevant benefits. In other words, you should ignore things that aren't relevant. Now, relevant costs, these include differential costs and differential revenue, kind of like marginal cost, marginal revenue under a proposed plan. So, for example, if we internally to the business, we want to take X action, right? Maybe make a new product. We would have projected $10,000 more of income and a projected $10,000 more of expenses, namely our differential revenue and our differential costs, respectively. In this case, right, our differential income would just be the difference between the two, $4,000, right? That's a relevant cost and relevant things we should consider when we make this decision to have a new product. There are other costs as well that are relevant and not relevant. So a relevant cost that we should consider is an opportunity cost. And an opportunity cost, as I have here, is the potential benefit that's given up when one alternative is selected over another. Right, so if I select X, then I miss out on Y. It's kind of like, what else, right? What else could I have been doing? So as I have here, right? So for example, if I work 60 hours a week, then I miss out on time with my family. So that would be the opportunity cost. It's what else I'm missing out on. And as you get older, right, and you start making more money, opportunity cost, you kind of think about these in your head, right? So imagine that you're making like $30 an hour, right? And you can pick and choose how many hours you want to work. And let's say that maybe you have to paint your house, right? And you could pay somebody $20 an hour to paint your house. Well, if you really don't want to pay the person, you could paint it yourself, right? And save the $20. But your opportunity cost in that case would be missing out on time where you could make $30. So in other words, in that case, it might be better to just pay someone and then go make money because you'll net like $10 more an hour. So opportunity costs are relevant costs. When we're making decisions, should we do X, we need to consider what else we would miss out on. Now, another type of cost is a sunk cost. This is basically a cost that has happened in the past, can't change it, it is what it is. These are not relevant costs and you should ignore them. So as I have here, right, for example, continuing to make a product nobody wants to justify an expensive machine we bought to make the product. So, sometime in the 90s, for example, they had Heinz ketchup that was like purple and green ketchup. If you don't believe me, look it up. You can Google it. It's like, kind of this little like wavy bottle that's like purple and green. And at some point, somebody in Heinz sat down and said, hey, this could be a really good product, right? Purple and green ketchup. And maybe they spent a ton of money on this like fancy mixing machine to make it purple and green, right? Now, when this stuff first came out, there was kind of a novelty to it. Like people were like, yeah, let's try it. That's kind of cool. But it didn't take very long before people were like, yeah, I'm not really sure I want green ketchup, or, that purple ketchup doesn't look very appetizing on my French fries, right? So imagine you're Heinz and you spent all this money on this machine and now you have this product that nobody wants. A manager inside there, they may look at this and say, we spent all this money on the machine. We have to keep making the product. That would be the wrong approach, right? In that case, the machine is a sunk cost. It already happened. We can't do anything to change it. In that case, we need to ignore it. And we really should be just looking at the fact here that nobody wants green and purple ketchup. Now, the last thing we'll talk about here is the difference between the traditional income statement and the contribution income statement. One is used more for like external reporting, where another is used for internal purposes. So the traditional income statement is that. It's like the traditional one you learned in financial accounting. It would be broken out a little bit further than this. But, to kind of truncate it, you would have your sales minus your cost of goods sold, namely your product costs, gives you your gross margin. Then you would back out your SG&A, things like your period costs, and that would get you to your net income, right? So this is like maybe, an equivalent of what you learned in financial. In managerial accounting, because we're concerned here with internal users and how we can help them with things like planning, controlling, and decision making, we may make a separate income statement that's a contribution income statement. In other words, it breaks out our variable from our fixed costs. We could analyze those to help us run the business a little bit better. So here we have our sales minus our variable costs gets us our contribution margin, minus our fixed costs gets us our net income, right? Different setup of it. The idea with it is the top number and the bottom number are going to be the same in each of them generally, right? What we're doing in between is we're kind of jumbling them up. We're just shifting things around because this viewpoint right here is better to analyze for internal purposes of running the business, whereas this view or presentation is better for external users. So this is just showing that, right? Here's a traditional income statement, a contribution income statement. So we have like our sales are the same on both. Our net income down here, this is the same on both, right? What changes is how we present it in between, right? It's like over here, it would be like if we had a peanut butter jelly sandwich and we put the peanut butter first and then the jelly. Over here, it's like we had a peanut butter and jelly sandwich, but we put the jelly first, then the peanut butter. It's still getting us to a peanut butter and jelly sandwich, but the presentation of it's different. How we kind of shake it out and how it unfolds. So with that, right, that's going to end the PowerPoint presentation here. Again, a lot of this will only fully make sense after we go through the problems together. You put in time on the optional questions. You look at the homework. The combination of that is where it all comes together. Again, the PowerPoints are just kind of like introductory, high level, prefatory, orienting us for when we go and do the problems that we'll be familiar with this vocabulary, that we can apply it to different situations, facts, and circumstances. So with that, I'll end chapter 1 here. I will see you in the next video for the problems on chapter 1.